what is hard money? I'm Chris Jameson with SF Lending, and in this section, we're going to cover what a hard money loan is and what to look out for in a lender. Hard money is a short-term, high-risk loan that is used by real estate investors to buy distressed assets, borrow the rehab funds, fix them up, put them back on the market, or rent them out long-term to tenants. The assets are typically too risky for conventional banks to put on their own books, so you can use hard money to acquire them, fix them up, and then refinance them. They're non-owner occupied for commercial purposes only, so they don't follow TRID or Dodd-Frank, any of those type of requirements. And I want you to think of hard money as just another loan product. There's all kinds of loan products, FHA, VA, USDA, conventional. I'm sure you've heard about a lot of them. Just think of hard money as a basic loan that you can add to your arsenal so you can pull it out whenever you need to use it to benefit you and your business. It's designed specifically for landlords and house flippers to minimize their out-of-pocket, leverage, and buy more houses in shorter periods of time, leverage other people's money instead of your own, saving cash for deals that don't qualify for hard money loans or deals that you want to not pay holding and carrying costs on. You can buy cash and save money that way. And also it protects you from buying a bad deal. So leverage can work both ways. It makes a good deal look great and a bad deal look terrible. Hard money is typically structured as a loan to value or loan to cost. Most lenders in today's market will do 70 to 75% of after repaired value. That's what the property would be worth as if it was fixed up. Or there's other lenders that do a loan to cost type product. So that's going to be maybe 100% of purchase and 80 to 90% of rehab, with a caveat of being the lesser of a loan to value. It's typically higher interest rates, like 12 to 14%. And I want to make note of one thing: lenders that charge interest on escrowed funds. This can be a phantom $200 to $800 a month extra, depending on how much money that you're holding in rehab escrow. So, for example, a lender that's charging 12%, and most lenders in today's market that charge 12% are going to charge on escrowed funds. That 12% charge on escrowed funds, say you've got $50,000, that's an extra $500 a month that you're paying until you draw that money out. A lender that is charging 14% that's not charging on escrowed funds, that's going to actually save you money in the long run when you're not paying that $500, $600 a month up front until you actually need the funds. Additionally, if you have enough capital to get through a deal and float the rehab, you won't pay any interest on those funds until you draw it down. Typically, loans have higher rates and fees, 2 to 4 points. Origination is normal. A point is 1% of the loan amount. So if it's a $100,000 loan, 1 point would be $1,000. And they also throw in a bunch of junk fees, really, because that's what the market can bear. Some junk fees range from underwriting fees, appraisal, review fees, doc prep fees, processing fees, admin fees, whatever. Those fees can range from $300 to $2,000 in total based on what lender you go to. And then the last thing is that they're typically a shorter term. Most loans these days, hard money loans, are 6 to 18 months. What you need to look out for on the 6-month term is typically there's an extension point paid at the 6-month mark. And oftentimes, after that first extension, your rate can increase to 18%. So if you've got a loan product that someone's marketing to you, and it's a very competitive market, so at the end of the day, when you boil down hard money, the true cost is typically about $300 to $400 difference between any loan when you boil it down to true cost. So if you've got a lender that's marketing 12 and 2, charging rehab on escrowed funds with a 6-month term where you're going to pay a point extension and the rate's going to jump to 18%, make sure you know the details of the deals before you get in them by asking around, because the last thing you want to do is get into a deal that you think is good where you're getting 12 and 2 and you really end up paying 14 and 5. Now, hard money can be extremely beneficial if used correctly. First, the approval process can take minutes and hours, not days and weeks like a conventional bank, a portfolio lender, a commercial lender, or a regional bank. The transaction timeline is very fast. Sometimes lenders can close in 1 to 2 days. I think 5 to 7 business days is typically normal, so have that expectation going in up front. You can create stronger offers with a tighter closing window, and you can even remove the financing contingency if you feel comfortable with that. Lastly, it's a reliable source of other people's money. Most lenders have very, very, very deep pockets, or they're built on a fund that has tens of millions of dollars. You don't have to worry about the money being there if you go to a credible lender that actually has the money to close the deal. Here's a sample of how a hard money loan is structured. Let's say that a house has a $200,000 ARV. Again, that's after repaired value, what it's worth as if you had fixed it up. A lender is going to loan you 70% of that amount, 70% loan to value. That's a $140,000 loan amount. For example, the purchase is $125,000, rehab's $25,000, and closing costs on a deal like this are going to be about $10,000. Using a hard money loan, your out-of-pocket spending, or your oops, is going to be about $20,000. If you're doing this deal cash, you'd have to put up $125,000 for the purchase, $25,000 for the rehab, and a little bit more for closing costs. You're going to tie up $152,000, $153,000. If you're buying the deal conventional, if it even qualifies for conventional financing, you've got to put 20% down on that $125,000 purchase, fund the entire rehab, $25,000 out of pocket, plus the $5,000 closing costs, because it's not quite as expensive of a loan, especially at a lower loan amount. I'll go a little bit deeper in this later on, and I'll explain how the total out of pocket between buying cash, hard money, and conventional relates to the returns that you get on a cash-on-cash basis. That sums up Hard Money 103. What is hard money? Again, this is Chris Jameson, SF Lending. Give me a shout if you have any questions. Send me an email or visit the website, sflending.com. Thank you.